All right, we're live. G'day, it's Scotty from Xenium Live, and today I'm joined with, by PJ. How you doing, PJ?
I'm very well here. Sydney, how's it going up there in Queensland today?
Yeah, it's going good. I mean, our internet seems okay. How's your internet going?
Mate, I can hear you loud and clear, but apparently there's maybe a little bit of a delay at your end. I don't know.
These
Something,
things
something must be
happen.
going on down here.
Yeah, well, it's Sydney. What can I say? All right,
Yeah.
so today I think we're really going to touch on probably one of the most important topics that I know I've discussed so far this year, and that is to do with the protection of your own cash in what would otherwise be considered a secure location like a bank. Uh,
Yeah.
I guess been following a bit of this sort of stuff over the past time since Bailin laws were talked about and passed. Quite a number of years ago, which you're going to touch on. And it was brought up again by a client the other day who was talking about having a $400,000 loan, and she had $400,000 in her offset account.
Mm-hmm.
And her concern was her money protected? Is there's a $250,000 cap for the government guarantee? Can the banks reach in and take it, that sort of thing? And she looked into a few different pieces on this. So I thought that was a really good topic. We should expand on that. And as I was considering that, we looked online, and then there was the ME Bank got roped over the coals this week in regards to reaching in to people's bank accounts and touching their redraw facility and things like that. So let's start off with that, because I know that you've looked into that, and give us your rundown on that, and I'll pull up the data on the ME Bank stuff, and we can look at what's actually said online.
Sure. Okay. Well, there's a lot in what you've just said in that intro. There's a couple of topics that we do need to discuss, and certainly that people need to be aware of. So, the first thing I'm going to start with is actually your deposit at the bank, because that's really ultimately where it all starts, right? People have for many, many, many years now had the impression that if they have cash on deposit at the bank, that it is, to quote a phrase, it's safe as houses, right? They're always going to get their money back. But it may surprise many of your listeners and people out in the general public that in actual fact, cash is considered on the bank's balance sheet. And for those of you who aren't accounting aficionados and things like that, that's just a record of the bank's assets and liabilities. On the bank's balance sheet, your deposit is considered a liability to the bank. So this obviously runs contrary to the way we think about deposits in the bank, because we think, once again, that if we put our cash into the bank, that we will almost invariably always be able to get that cash out. But the reality is that that is actually not the case. That, because it's a liability to the bank, and this is where we sort of segue into a bail-in and what might cause a bail-in. We have a situation we had a situation post GFC. So I'm talking 2012, 2013. I don't remember the exact year, but I think it was 2013. When a little country down in the Mediterranean known as Cyprus actually confiscated up to about 50% of deposit holders' cash to effectively recapitalize their bank. And this became known as a bail-in. So through the GFC, of course, many of you would remember, we had banks failing, we had depositors at risk, we had the Federal Reserve in the United States and Treasury and the government really initiating and orchestrating bailouts. So they were basically injecting liquidity and cash into these institutions to give them enough operating capital, et cetera, et cetera. So they would bail them out. And at a certain point, the system ran out of money, and poor Cyprus, which is a pretty small country by all accounts, was this the unfortunate, in the timing of all of this, the unfortunate recipient of or non-recipient of bailout money, and as such had to come up with a new idea, and that was to bail in. So they confiscated deposit holders' money, and they did this overnight. So effectively, if you could imagine this, you go to bed on Friday night with $100,000 in your bank account. and you wake up on Monday morning and you have $50,000 in your bank account, and the bank sends you a note and says, thank you very much, Scotty. We've had to recapitalize the bank. So now you own $50,000 worth of Bank XYZ shares, which is effectively what they do in a bail-in to recapitalize themselves. So this is first and foremost the issue that a lot of people aren't even aware of, is that there is legislation and there are laws that actually allow this, and it is able to be done in Australia, where a bank can effectively do what I've just described, a bail-in. Now, moving on to the ME Bank situation, this was a little bit different. It wasn't a bail-in as such. So the issue with the ME Bank story is that it revolves around redraw and mortgages. So what we learned in the couple of days post the actual event is that ME Bank's mortgage systems apparently were not amortizing loans correctly. So in other words, if you made a $2,000 a month mortgage payment, the reality is you probably should have been making a little bit more. And they had built up extra reserve or extra cash in clients' redraw accounts that they basically weren't entitled to. And in typical bank fashion, and I guess we'll probably never know the real story, the full story, I should say here. But in typical bank fashion, instead of really communicating with anybody and telling them what they're going to do, or doing it and then sending a letter 3 days later, they just went into clients' accounts and took money out and sort of said, oops, sorry, you shouldn't have had that much money, so we're just going to go ahead and take it out. Now, they broke a bunch of rules, and specifically, I was looking at this the other day. I can't remember the exact rule, but they did violate some legislation where they are required to notify deposit holders, mortgage holders, whatever, of a change or something they're going to do on their account. So this is why they're really in deep doo-doo with APRA right now, because they didn't follow the rules. And of course, it's a public relations disaster, because it now calls into question for any financial institution in Australia. And I'm sure they're fielding a lot of calls right now from people saying, can you just take money out of my account? And again, the reality is, as I opened with, yes, they can. But if you really think that through, I suppose a lot of really bad things would have had to have happened for a bank to do that. And you'd have to think that it would be one of the last resorts, the last things they would resort to, because it would be an absolute public relations disaster if they were to do that. So that hits a lot of the stuff that you just said in your intro there on this whole topic.
So the couple of things I want to touch on is that ME Bank is owned by industry super funds, as it says here in the ABC article.
Yes, it is.
And they're the ones that are constantly advertising that compare the pair, and we got lower costs and things like that. But maybe if you got your money in our bank, we'll just take it. And so the other thing I want to touch on is
everybody else.
Yeah, let's go through the exact situation in ME Bank. And I'd also heard that Suncorp was reviewing, or had done it to a couple of people as well. And let's break it down to the clarity of what is a redraw versus what is an offset, and how they can revalue the loan in this position.
Excellent question, and great distinction to be made, because certainly for anyone that's listening to this that has a mortgage, there's a good chance you have an offset account, and there's also a good chance that you have a redraw function on your home loan. So an offset is actually a feature of a bank account. So let's just use Suncorp as an example. They're a deposit-taking institution. They can have bank accounts. And if you had a mortgage with Suncorp and were on, let's say, one of their professional packages, you were probably given a bank account. And one of the features that those bank accounts have is this thing called offset. And basically it means that if you have a $100,000 mortgage and you have $50,000 sitting in your offset account, it means that they're only going to calculate interest on $50,000. So they net the two off, and they say, because you have this $50,000 in offset, we're only going to charge you interest on $50,000 of your loan. It's a really, really great feature, and it's a great way to actually reduce the amount of interest that you pay. A redraw works very similarly, except a redraw is not a bank account. So a redraw is where, if you have, let's just say you have a mortgage account and that's all you have with an institution, and there's a lot of institutions that are non-banks and even banks that you just take your mortgage out and you don't have any other banking relationship. It's simply the mortgage account. And so what you can do is make extra repayments on that mortgage. And if you do make extra repayments above what is required to be repaid, so I mentioned amortization, that's a big financial word, but it basically means over, a 25 or 30 year period, you're going to pay your loan down to zero. This is on a principal and interest loan. But if you make repayments that are in addition to what's required according to that amortization schedule, most banks allow you to redraw the difference. So again, in that example I gave, if you had a $100,000 mortgage and you put in $50,000 into your redraw, then you should have, and it won't be exactly this way if it was principal and interest, but you should have approximately $50,000 available to redraw. So that's that's the distinction between the two types of account. So what did you want to know about the actual redraw? Was there a second thing you wanted to?
Yeah, so there was. So let's say you had that loan, $100,000 loan, and you put $50K in there as a redraw, but you didn't pay any more loan payments. And let's just say your repayment was $1,000 a month, right?
Yeah.
So pending the interest recalculation, because it's on a smaller amount, let's just say, so $12,000 a year would actually come down off that loan balance, even if you didn't pay any more. Is that my understanding?
Yes, that's a really good question and a good point. And I can speak from personal experience on this. Typically, what a bank will do, and I can speak from personal experience because I have a mortgage that doesn't have an offset; it actually has a redraw, and I do put extra money in that. And what a bank will typically do is, if you are ahead in repayment, so if you have extra money in your redraw, the banking systems will acknowledge that, and instead of charging you your normal monthly mortgage payment, it will just debit the redraw. So it's something you have to be careful of with redraw, in that you want to make sure that if that is occurring, that you are making your regular mortgage payment. So this is where some people get caught out with mortgages, as they go, I didn't, my mortgage payment this month wasn't very high, or they didn't take the full mortgage payment. And that would be because quite possibly you have a lot sitting in redraw. And so over time, yes, that will run down and you will not have access to that. So a great question and a great point about redraw. Now, this doesn't happen with offset accounts because, of course, the offset account is just a bank account. And if you had offset money sitting there, or money sitting in that bank account, if that was the account that the bank was debiting for your monthly mortgage payment, then of course it would run down as well, but you would see that. But the likelihood is that, because you notice that, of course, and oftentimes people use their offset account to have their pay deposited into, that sort of thing, or rental income deposited. It's constantly being topped up, so it's always at a certain level. But with a redraw, you do have to be careful and monitor that because of what I just described.
Yeah. All right. So there's definitely time for weirdness in the market, right? I mean, we've seen this readjustment of the redraw account. And it should be noted that while it looked like they'd taken, the bank that is, had reached in and take those people's cash, I mean, essentially it was sitting on the loan to reduce the loan as it was, right? I mean, so,
yes.
I mean, they kind of took the cash, but then they reduced the loan. It wasn't like they just reached in and took the cash.
Yes.
So that's probably what we need to touch on. And before we get to the next really weird point, we should probably just have a look and think that, I know you and I have discussed this just before the show, and there's a lot of weird things going on, but, I didn't think things could get any weirder. And then I saw this week, and a monkey on a bike coming up and trying to steal a kid, right? So I think that pretty much shows us where we're at for this year and the weird things that are going on. I thought I'd seen everything, even coming to banks, but there's a monkey on a push bike coming to steal a kid. What's that got to do with banks? Well, that's our next topic, right? Okay. So we need to go and now talk about how safe your money is in an offset account, because that's going to merge over into bail-ins. And while we're doing that, we've got a couple of comments picking up here. Look out, we've got serial commenter and last week's guest, Steve Skeen. Skeeny says banks are recently being penalised for not calculating offset interest accurately. Yep, okay. Look, anytime the banks get penalised, that's probably a good thing for most of us, except at the end of the day, we will end up paying the bill. Excuse me. So let's go on to a bail-in. Some of our viewers and listeners may have heard what a bail-in is, others might not. Give us your classification of that. I've got some websites that we can talk about here. We've got the, not Wikipedia, Investopedia we can go through on a bail-in. Yeah, give us the brief rundown, the PJ version.
Yeah, okay, sure. So just before I do that, I want to just pick up on that very last point you made about ME Bank and taking money out of redraw. That was definitely not a bail-in. That was simply the bank, I think, acknowledging that they had not calculated the correct amount of amortized loan balance. And we're basically saying to customers, we're going to make an adjustment to your account. Now, the way they did that was obviously a complete and total shit show, and they shouldn't have done it that way. They should have informed clients first, probably worked out, what the deal was, probably call them individually and say, hey, this has happened. They didn't do that. And so now they have a lot of egg on their face. But that was definitely not a bail-in. So a bank bail-in, once again, is where a bank has run into a tremendous amount of financial difficulty. And it would probably be, in a time, funnily enough, where GDP was falling massively, unemployment rates were rising quickly, house prices were falling, interest rates were at record low levels. And remember, banks make a lot of money off interest margin. So low interest rates are actually a really bad thing for the bank, which is, in case you're interested, that's why banks typically delay passing on any interest rate cuts, because it's cutting into their margins. But a bail-in, for a bail-in to occur, we would have had to really have a horrendous situation occur somewhere in the financial system. And again, what happened in Cyprus is the bank simply, and I think this word is appropriate, stole money from their deposit holders and converted it to equity in the bank to, quote unquote, recapitalize that institution. So effectively, they're saying to their deposit holders, we're taking your money and we're going to move it from a unsecured liability, which is what it is on the bank's balance sheet, over to the bank's as an asset, probably to the bank, which would be shareholder equity or something along those lines on the balance sheet. So again, they are taking money that is on deposit, taking it out of those depositors' accounts and putting it into effectively the bank's control and their side of the balance sheet ledger. Not a good thing.
No, they're not a good thing. Okay, so these laws were actually passed after GFC in a lot of countries, including our country, the lovely Australia. And I guess you've just explained that essentially a bank can come in and recapitalise and equal out their balance sheets, et cetera, et cetera. So when can that happen? And is the customer protected?
That's a very interesting question. And the limited amount of reading that I've done on this, it's a very interesting scenario. So we have this thing in Australia. I don't know the exact terminology, but it's basically a deposit protection scheme. And in other words, if a financial institution goes to the wall, an account holder has their deposit account protected up to 250,000 Australian dollars. And I believe that's per person and per institution as well. So, if a bank were to do a bail-in, my reading of this is they would probably, I'm going to say again, steal the money that was above the 250,000 threshold because that was protected anyway. So let's just run through a scenario on this. If you had, let's say, $500,000 in the bank, and I know you got a lot more in the bank, but we won't disclose, what you've actually got in the bank, Scotty.
Yeah.
But let's say you had $500,000 in the bank, right? And there was a bank bail-in. I believe what would happen is they would very well try to take, as much of that additional money above 250,000 threshold as they could get their hands on, maybe 40, 50, 60% of it to recapitalize the bank. But they would stop short of where the guarantees kick in. So in other words, you would be protected up to 250,000. but anything beyond that is probably fair game.
Yeah, okay. So every dollar above 250,000 is, so in my client's example of 400,000, her risk of exposure is 150,000.
Yes.
All right,
That's
just
right.
making sure I didn't have to get a calculator on that one. So let's talk about her situation. I mean, that's not necessarily a common situation, but it's probably not particularly uncommon, especially as people perhaps in retirement or super or whatever. There's going to still be a lot of cash sitting around. There's obviously other options that they can do to tie those things up. And we were talking about, spending it, buying gold, buying property, buying equities, term deposits, like what, anything other than in a bank?
There's lots of options. I mean, I suppose if you needed to be in cash, the first option is to just spread the money to a couple different financial institutions. I know that could be a headache, but certainly if you had, let's just say let's round it off to make the maths easy. Let's say you had $500,000. You put $500,000 with bank one and 250,000 with bank one and 250,000 with bank two, separate banks. ADI coverage would be 250. So you would be, you would actually have all of your money then protected because it's at two different institutions. So that's one way, I suppose, to mitigate it if you had to hold cash. Another way is, as you described, you could buy anything, really any asset. You could convert that cash into some other asset. You could buy some property, you could buy shares, you could buy some gold, you could buy wine, you could buy art, you could buy, a classic Monaro, I don't know, whatever. You could buy something with that such that you had the wealth hopefully preserved in something that would appreciate in value as opposed to depreciate.
Yeah. But obviously people have it in cash because it's the most liquid form. So what we're saying is you're actually being penalized for having the most liquid form of monetary value.
Well, you could be penalized for that. So at the moment, of course, and before we start any bank runs, with the thousands and thousands of viewers and listeners that you've got on this show,
we are global.
We don't want to start a bank run in Australia. Okay, so let's just be clear about one thing first and foremost. The banking system in Australia is certainly one of the best in the world. And what we're describing and talking about today is a topic that I certainly, in my wildest dreams, would never imagine that it could happen in Australia. I'm sure a lot of people said that about, Merrill Lynch falling over in the U.S. and Bear Stearns going to the wall. And what was the name of the bank in Ireland that went to the wall? Northern Rock or whatever it was called. So, these things are okay until they're not okay. But I still think Australia has one of the most sound financial systems in the world. So we're not talking about anything that's imminent or that really you should be overly concerned about. So, I just want to make sure that people aren't going to run down to the bank and pull all their money out. But it's certainly something that you need to be mindful of because one of the other things that's floating around out there is the possibility that we will see negative interest rates. Now, there's a whole nother topic we don't want to go into today, but that is effectively where you pay to have your money on deposit in the bank that isn't even really protected because the bank can steal it. So turn that over.
You're being penalized again.
Yeah, you're being penalized.
It's just another way to be penalized, right?
It is. And I think, with cash, really ultimately what this is cash is, as you say, it's the ultimate form of liquidity. And you want to be in cash if you're buying a house and you need to have that deposit. If you have big expenses coming up, obviously you need to have cash to cover those things. But if you don't need a lot of cash sitting around, my view as a qualified financial planner is that you should find ways to invest that to ensure that you're protected against the insidious tax, which most people don't even think about, which is inflation.
Correct. Yep. Okay. So in my research coming into this, I looked into the legislation on the Bailin Protection. So there's a section here which I think needs more explanation, and we're probably not in a position to do that. But it's talking about an ADI, an authorised deposit-taking institution, that has been declared. And by the declared, the paragraph before means it's stuffed, right? So it's gone into like receivership management by the government, for want of a better word.
Mm-hmm.
And it says for the first 3 years of the scheme, the amount that can be appropriated for the purposes of meeting depositors' entitlements is unlimited. So just to explain that, that's talking about that $250,000 government-backed protection that you had alluded to already in those bank accounts. So you could have at 3 different institutions, or 2 different in your example, 250 in one, 250 in another. One of your institutions where you've got your money in has gone bad, and that's protected by a government guarantee for the first 3 years of the scheme. Now, the scheme is the management under which the government steps in.
Mm-hmm.
However, after 3 years, the maximum that can be appropriated is $20 billion. Now, you and I discussed this briefly before we come on the call, and neither of us have answers. And I really can't find too much else about this, because the first thing that comes to my mind is, well, if you don't have your money out of the bank when it goes bad under a government guarantee within 36 months or 3 years, you're a bit slow, right? Then I was thinking, well, I mean, let's take a big bank, for example, and we know how quick government moves. Because it's never happened before, how long could this stuff actually take to go through and be processed? Would it be more than 3 years? I don't know. But to me, that's something that needs to be answered. And perhaps, as you said, it's completely irrelevant because the government guarantees there will just be, processed, and you get your $250,000 back. My question would be, do we have any idea how long that time to process will take? And if it takes more than 3 years, the government's saying that they're only going to give $20 billion to an ADI. It doesn't take long to do a calculation, even on a napkin, to see that that'd be cents in the dollar against their guarantee. You're not going to get anywhere near your $250,000 back.
And obviously we don't have the answer to this question, nor do we have any historical precedent that we can draw upon.
Exactly.
The only thing I can actually think of in my life history is the savings and loan crisis that occurred in the United States during the 80s. Now, I was only a young tacker back then, so I remember it, but I don't have any financial memory of it because I was probably, 11 or 12 or 13 years old or something like that. But I do remember institutions being shut down, being taken over by the FDIC, the Federal Deposit Insurance Corporation. And incidentally, in Australia, it would be APRA who would step in and administer that program. But people, having to make claims through the FDIC and getting their money back. Now, again, I don't know how long that took, but I suppose it would be one of those situations where it would behoove the government to move as quickly as possible to square up deposit holders and make them whole again for obvious reasons, not least of which is restoring confidence in the banking system. So I would like to think that if something were to occur at a major institution here in Australia, that they would move fairly quickly to shore it up. With regard to the money restrictions that are talked about in the Act, again, we have no historical precedent to rely on there, but you'd have to think that because we have this thing called the printing press, and ultimately our Treasury can create unlimited amounts of money, I dare say that any limitation in the legislation, if it was like, let's say, the big bank that has the black and gold logo were to go down, they're the largest bank in Australia, there would be multi billions and billions of dollars of exposure that may very well tap out any of these facilities. So you'd think the government would move fairly swiftly to restructure the bank, recapitalize it, do whatever needed, merge it with someone else, do it, whatever needed to be done to make sure that didn't happen. And incidentally, that just jogged my memory. If you recall, during the GFC, we had a number of mergers, one of which was that big black and gold bank bought out another bank that's located out on the West Coast that has a orange logo, not unlike what's behind me right now, but has an orange logo. And they merged. And I can't necessarily substantiate this right at this moment, but I believe it was because that bank that was bought out or merged was in a lot of financial strife. And APRA did an arranged marriage and said, guess what? You get to buy this bank and take them onto your balance sheet. And I think there was a few situations like that in Australia that went on, because if you recall, during the GFC, we had a little bit of merger activity that went on in the banking system. So again, I just think that if we were to see a major financial institution start to run into trouble, there would be a number of stopgaps that would be put in place by the government to ensure that we do not create a panic and a bank run on all the other banks.
Good point. And look, as I said earlier, there was different, people have cash in there for liquidity, and Steve makes a good point that I sort of touched on briefly, was to term deposit. I mean, that's probably the thing that most people are most familiar with in a bank without going outside the bank in terms of equities and property and other gold and other investments. They would essentially say it's a term deposit. So just as we finalise things today, give us a breakdown of the term deposit and how it's different to having just cash in the bank.
Sure. Well, I mean, a term deposit is just a contracted arrangement between you and the bank to effectively you're lending them the money for a specified term. So let's just say it's a 1-year term deposit. You have agreed to hand over your cash, let's say again, it's $100,000 to the bank for a 1-year term at an agreed interest rate. So that's where you see, the little the billboards outside the front of the bank on the sidewalk that have the term deposit rates, the specials, and so forth. They might have a 3-month, 6-month, 9-month, 1 year, whatever. And they're trying to effectively, what the bank is trying to do there is put cash, lock it down for a period of time so that they can then go make loans and ensure that they have capital for a specified amount of time. So that's kind of how a term deposit effectively works. But it is a contract, if you would like to speak in those terms, between you and the bank for you to lend the money for a specified amount of time for an agreed interest rate, usually a fixed rate.
Yeah, it's a contract, right? So instead of an IOU in one regard of you cash in the bank, it's a contract of a product arrangement.
Well, it is. I mean, it's still an IOU though, right? Because if the bank closes, where's the money going to come from? So it's still an IOU. And again, it still sits on the bank balance sheet as a deposit, even though it's a term deposit that is a liability to the bank. So it is still a liability on their balance sheet, irrespective of the terminology you use. It's still a deposit, as the term deposit denotes.
Yep. And we've got a comment in here from Seeker of Awareness. Thanks for joining us on YouTube. It's good to hear us talk about gold being an investment. Well, I mean, some people
don't even get me started on gold, Scotty. I mean, that might have to be our topic for next week.
Well, it could be.
Or 2 weeks' time. Yeah.
Because you've got a bit of experience in the gold field, right?
I certainly do. I've been investing in gold since the GFC. Love it as an asset class. I think many people underrate it. Just a little snippet on gold. Prior to the modern financial era, so I'm going back probably pre-1980s, most people would have anywhere between a 5 and 15% allocation to gold in their portfolios. But the modern financial, media and other, big investors like Warren Buffett and other people have poo-pooed gold because they say it doesn't have a yield. But the reality is gold is the ultimate preserver of capital, and it is one of the best historically hedges against inflation. So, Matt, I think we have our topic for 2 weeks' time.
Well, I think it's a good topic, and I think we can then, depending on time, we can start talking about how currencies were attached to them and now they're not, and because that could be a topic for about 6 weeks.
It easily, yeah. I could talk about gold all day. Really, it's a fascinating subject, but again, it's an asset class that unfortunately most of the modern financial advisors even don't appreciate, don't understand its function in a portfolio, and for that matter, don't even really know how to gain exposure to it. So we could really delve deeply into that whole topic. It's one that I really love. I think you must understand gold, know when to use it, and certainly know how to invest in it.
Yeah. Well, the only gold investments that I've been sort of dragged into over the years, mate, usually involves something to do with my wife, and I think that that's probably not totally uncommon there. So
and probably around her birthday too, right?
Around her birthday, and that's always, it was good. I enjoy giving gold in that way. All right, so let's recap. It was really important today to talk about the protection of cash in your own bank accounts. We've covered the difference between redraw and offset accounts and how they're quite substantially different. We've talked about the bail-in laws, what an ADI is, an authorised deposit-taking institution. We touched on the Act, and we probably need to come back to everyone. If you want to know what we find on the Act, you need to join us at our Xenium email address here. Let's see where we go. And you need to chuck us an email, and we'll put you on our mailing list, and we'll keep you updated with what we find on the $20 billion cap after 3 years. And we've got our topic for a couple of weeks' time, which is gold. So we've definitely covered a lot of ground today, PJ. Thanks for that.
We have covered a lot of ground, and thank you, Seeker of Awareness, for that great segue for our next topic. And that probably is worth saying to any of your listeners and anyone that tunes into this, maybe on the rebroadcast on your thousands of syndicated stations, to send us comments and questions that you'd like us to cover, because we want to be driven by the things that are concerning you, especially in this time and age of, gosh, just being a complete and total shit show out there in the financial world, and people need guidance. So if you do have questions that you want answered, let us know.
Yep. No, that's a good one. Thanks for that, PJ. We had a few people stop by today. We got Todd Brandon. G'day, Todd. How you going? We got Michael. He's always in for a bit of a chat. And of course, Steve Skeen and Seeker of Awareness. And Lachlan. Lachlan's been tagging his dad in our conversation today. All right, look, we've gone over time. How unusual. Thank you very much for joining us, and for joining us on our podcast, Real Property, Real Wealth, which will be out in a couple of days with this topic on it. As PJ said, hit us up on the email below, all the details in the podcast. Send us your feedback, send us some topics, and we'll cover them live on air. And don't forget to always jump on and join us and give us your questions live, because we do that as well. All right, that's it. Scotty from Xenium HQ, and this is our show, Xenium Live. Thanks again, PJ. We'll see you all soon.